Hello everybody, good evening. Welcome to JAIIB English Medium channel. I hope all of you are doing fine. Today in this particular session, we will be talking about Indian economy and Indian financial system. Now, as you know, that IFS exam is scheduled on 3rd of May. And when we talk about the approach which we must follow right now, it should be brushing up your concepts. You must understand that now the time is limited. 63 odd days are left with us effectively if we keep aside the time period for your practice and somewhat revision as well. Then only 63 days are left. So right now your focus must be on consolidating whatever you have read, and if you are lagging behind in completion of syllabus, then my advice would be try to arrange all those topics which you have done earlier and try to revise them again and again, and some concepts which are left now you should go with the short and crisp videos. Okay, so IFS today will be talking about unit number 37. As you know that right now we are covering your module D, and in that unit number 37 is one of the important unit when we talk about the processes followed by the businesses. These are what we have: the factoring, we have forfeiting, and TReDS, that is trade receivables discounting system. Now when we talk about the businesses, the business model, how they function, simply stated, you are providing certain funding to a particular person, and that person in turn will provide you some service. Okay, that is how the business models work, the normal business models. Now, if I talk about the overall business world or the scenarios which are there in the business world, you won't find that every time the purchaser, whosoever is purchasing certain goods from a seller, they will be then and there giving 100% amount for the particular service. No, it does not happen in the real business world. There you must be having certain kind of arrangement, certain kind of setup via which you will be settling certain dues in the future date. And it becomes a very tedious exercise whenever your business is going through already a rough patch and turmoil is there in the businesses. Still you are moving again and again, knocking the doors of that particular buyer who has not paid you the money. For that we have different processes, starting off with factoring. So in this entire unit we will be learning about various types of processes, or for that matter the business models we utilize for recovering various you can say amount from different types of sectors. Like for factoring we have mostly the domestic, fine, as well as international also. Sometimes you will find international as well. Then for forfeiting, mostly it happens in the international transactions. For TReDS, when we talk about the MSMEs, whenever they are producing certain goods, whether they have received the amount or not, that will be ensured via your discounting system known as TReDS. And in this entire unit we will be learning about not only these business processes but also various types. So types of factoring we will be looking into, how the forfeiting is different from factoring. Then when we talk about the point of difference between all these three, fine, we have the factoring, we have forfeiting, and the TReDS. The three have very huge differences. It's not that there's a thin line of difference. No, good amount of difference is there. Lastly, what is the process flow? How the process occurs, the buyer and seller arrangement is there. In between that, how a particular third party will be involved, why it is involved, the how, the why, and what of all these trades we'll be learning in this chapter. So first thing first, let me just tell you the basic difference between these three processes. Ultimately, when we talk about all these processes, they are what? They are simply some arrangement. Okay, arrangement is the keyword here. We are doing various arrangements here. Okay, we are only concerned about certain arrangement. Okay, more or less these are the arrangements, the best way to put out all the three. So when we talk about whether we are having certain trade going on within the country, then which type of process will be involved? So first of all, for factoring we will be having domestic trade. Whenever there is a domestic trade, you will be having the factoring. Mostly factoring will be there. Some international transactions they can also settle, but mostly for 90%, more than 90% of the businesses, they will be happening within the country. Forfeiting, always it is international. We are only talking about the exports, fine, only international. For TReDS, it is domestic, specific to India, because for MSME we have this particular arrangement. Now there comes a point where you can hold accountable certain parties. There are various parties are involved, and within these parties, who all can be held accountable. So when you talk about this particular clause of recourse, what is recourse? Whether you can hold accountable somebody or not. So when it is with recourse, then you have somebody to go, to look after, to look for your resolution, whatever the resolution you want. And if we are talking about without recourse, nobody is available to help you out. So with recourse, without recourse, let's see what about these three arrangements. So when we talk about factoring, it can be with recourse, can be, not always. It can be in the form of, you can say, grievance redressal mechanism will be provided. So you can pay back if the buyer fails. If the buyer has failed, then you can have the arrangement via which your factor will be providing the money. Because ultimately in factoring, what happens, that you are having the services of a factor, and that factor is now responsible to recover from the particular buyer. You won't be knocking the doors of the buyer again and again in order to recover your dues. In forfeiting, it is always without risk, always without recourse. The bank takes 100% risk here. The bank won't be having any kind of recourse, anybody else to look upon so as to recover the money. They will be bearing the 100% risk. For TReDS also, without recourse to the MSME seller. No recourse is provided to the MSME seller here. Then we have duration. What is the duration of all the three arrangements? Shorter duration, you can say that factoring is for the short duration only, 30 to 90 days mostly it happens. For forfeiting, medium to long term, you can expect up to several years also. For TReDS, it is short term, usually within 180 days, 6 months, at max 6 months. For the negotiability, whether you can negotiate from the factor when we talk about the factoring process. So yes, based on an invoice, you can negotiate. For the negotiable instruments involved in forfeiting, because it is international or the exports are involved, so negotiable instruments, bills of exchange will be there. So yes, it is based on the type of bills of exchange. For TReDS, it is based only upon the digital invoices on a platform. Whatever the digital invoice is there, based on that, negotiability clause will be there. What about the cost? So fixed fee will be there, which will be set up by a factor in case of factoring. When we say forfeiting, it utilizes certain fixed exchange rates, which are your the discount rates are based on LIBOR as well as SOFR. So London based exchange rate, or for that matter SOFR, both are available for the forfeiting process. In TReDS, you will find that there is a competitive bidding. Lowest interest rate will win, and ultimately the cost will be finalized. Okay, so when we talk about such scenarios where the factoring, forfeiting and TReDS are happening, we are only focusing on certain terms, certain terminologies, and we only talk about the businesses. Fine? No private transaction is ongoing. We are only talking about the businesses. Fine? So businesses are involved here. Next, let's try to now have an elaborate discussion around these three terms. Starting off with the factoring. What do we mean by factoring? Now see, more or less factoring is not a new concept. It has been there since the time immemorial, I would say. So it is just an arrangement for financing a company's business against the invoices raised on the buyers, and in which the factor is responsible for credit controls, sales, ledger administration and collection activities. So we have one buyer and then there is a seller. So the buyer has provided certain you can say preference to the seller that I want this particular item on, let's suppose, this date. Today only I want this particular item. So for the seller it will be a sign where they are only concerned about the services, or for that matter the recovery of dues. If you are buying something, the seller wants what? Money back. And if you are not able to pay this today, the dues which are to be paid to the seller by the buyer, if they are not settled today, then seller's business will get hampered. Here enters your factor, where the factor will be what? A particular entity which will be providing the final solution for the seller. The headache of seller will be nullified. It will be nullified by the interference of a factor, because now the seller has outsourced the business of recovering to the factor, and the factor will be doing what? On behalf of the seller will be recovering from the buyer and paying the money directly to the seller first. Fine. The upfront fee, let's suppose buyer has given 85% to the seller. The remaining 15% will be provided by the factor to the seller, and then this 15% will be recovered from the buyer by the factor. Okay, so first you will be providing the money to the seller, and then you will be recovering the same amount of dues with the buyer. So the collection activities, the credit control, sales, ledger administration, all these are the functions of your factoring. The business of factoring in India is regulated by the Factoring Regulation Act 2011, Section 2, Clause J of the Factoring Regulation Act 2011, which defines the factoring business as follows. So in India, whether we have a specific legislation for the factoring regulation, yes, it is known as FRA, Factoring Regulation Act 2011, and which section per se? The Section 2, Clause J. What do we mean by factoring business? The process flow is clear to everyone, right? But the examiner in IIBF, you will find they ask specific questions. They will be asking you directly that whether the following definitions are with reference to the Section 2 Clause J of your FRA 2011 or not. So let's go by the definition first. Factoring business, it means business of acquisition of receivables of assigner by accepting the assignment of such receivables or financing, whether by way of making loans or advances or otherwise, against the security interest over any receivables, but does not include these two clauses. So you are doing what? It is just a business of acquisition. You are trying to acquire certain receivables and provide the same to the seller, because seller wants what? Seller wants his or her business to be up and running. They cannot wait for the buyer to fulfill the particular transaction. So what does it not include? The credit facilities provided by a bank in its ordinary course of business against the security of the receivables. So banks also provide certain services where they will be providing the loan to the seller, and quickly the seller will be able to revamp all those processes which were right now stuck because of the payment delays made by the buyer. But whether you can directly call it as a factoring business, answer is no. Any activity as commission agent or otherwise for sale of agricultural produce in the agri market, find the commodity market, or goods of any kind whatsoever, or any activity relating to the production, storage, supply, distribution, acquisition or the control of such produce or goods, or provisions of any other services. So more or less any other activity which does not fall under the purview of this definition, you will be not making it noticed as the factoring. So it is just a service that is concerned with the financing and collection of account receivables in domestic as well as international trade. Fine, mostly domestic, but yes, international can also be there. So it is what? You are providing a service. Factoring is a business and we treat it as a service provided to the seller. That is concerned with the financing. Fine, you are acting as what? One type of financer. Fine, financier for the seller. Collection of the account receivables also, you are collecting also. So more or less the apt keyword will be debt collection. Fine, you are trying to collect the debt on behalf of the seller and ultimately rejuvenating your funds also, because upfront you will be providing the money to the seller directly and then recover from the buyer. It is continuous arrangement in which receivables created out of the sale of goods or services are sold to an agency which is known as a factor. This arrangement is called factoring. Fine, it is just an arrangement whereby you are providing what? The factoring is just an arrangement whereby you are providing certain services to the seller. And when we talk about the continuous arrangement where the receivables are created out of the sales of goods and services. So whatever the sale of goods and the sale of services is, we will be providing for the amount which is involved in that particular sale. Fine, the amount is ultimately what is required to be paid. It is an arrangement for management of receivables, maintaining the sales or receivable ledgers, submitting sale accounts, collection of debt, etc. This can be with recourse or without recourse, but in India without recourse is not permitted. So always remember, in India factoring is not permitted without recourse. You must have a final say that who will be taking care if the party fails to repay the factor. Under the factoring arrangement, as soon as the invoice is submitted to the factor will pay, let's suppose, 85% of the invoice to the seller. That's what we have seen. In turn, the factor will collect the dues on due date from the customer or the buyer. The balance of the payment will be paid to the seller on recovering from the buyer. The factor will recover the finance charges for funds prepaid to the seller against the invoice. So step 1 will be what? You will be simply doing, so step 1, we have a buyer and there is one seller. So seller has sold something to the buyer and based on the transaction, seller has given one invoice to your buyer. Now the buyer is unable to pay today itself, then and there itself. So what the buyer will do? Buyer will say that I will be paying you on a particular due date. A date will be decided. But since the seller has the invoice, it can approach a third party which is known as the factor. Now factor on behalf of the seller will try to provide for the funding. So factor will do what? Let's suppose the transaction here involved 100 rupees. So the seller will be having 85 rupees upfront by the factor only. Factor will provide the 85%. And the remaining 15%, this particular factor will approach the buyer for the same. And once the buyer has provided all the money, everything, the 100 rupees to the factor, then the remaining 15 will be provided by the factor to the seller. Okay, so you can say a simple arrangement, but it might look complicated if you are not paying attention. The balance will be paid fine once the recovery has been done from the buyer. The factor will recover the finance charges for funds prepaid to the seller against the invoice. They also recover service charges for management of receivables. There will be certain service charge also, so that will also be recovered. The factor may or may not accept the incumbent credit risk. So when you talk about the credit risk which is involved in the entire setup, it totally depends upon the factor, upon the agency, that whether they are accepting the credit risk or not. If the buyer is not paying the money, then whether the brunt will be borne by the factor or it will be with recourse. Then factoring enables companies to sell their outstanding book debts for cash as well. Fine. So win-win situation for the companies as well as the third party, that is the factor. Okay, so both the parties are happy thanks to this arrangement. Now let's try to decipher with an example that how this factoring works. Let's suppose there are various parties involved in a particular setup. There is a local Indian business. A small manufacturing firm in Pune supplies 10 lakh worth of auto components to Tata Motors. Tata Motors give an invoice saying they will pay in 90 days. Now this company, which is your the small manufacturing firm in Pune, they cannot wait for the 90 days because they are firstly the small business firm and they want to expand their business. That is how the normal scenario works. So they need the cash. What do? The firm needs cash today to buy raw materials for the next order. They cannot wait for 90 days. The firm takes Tata Motors invoice to SBI Global Factors, which is one of the factoring agency. So SBI Global Factors will buy this 10 lakh debt. They give the Pune firm roughly, let's suppose 8 lakh immediately, that yes, you have the invoice, I'll take the invoice, I'll give you 8 lakh. And when we talk about the remaining amount, what will happen to the remaining 2 lakh? After 90 days, when Tata Motor pay the full 10 lakh directly to SBI, SBI will then will give the remaining 2 lakh to the Pune firm minus their commission or interest. Fine, commission will be charged. That is how factoring works. Okay, in real life, that is the process flow. Now comes the point where we were discussing the recourse, with or without recourse. What is this recourse? And what is the difference between factoring, forfeiting and TReDS when we talk about the recourse factor? So in factoring, supposedly the Reliance company is there and they does not pay to the bank. Okay, so SBI factors is there. Supposedly Reliance is not paying back to the SBI factors. The bank might come back to you and ask for the money back. This is known as with recourse. Okay, they won't say that okay, now your loss is my loss and I will be bearing all the losses. No, not at all. In forfeiting, once the bank buys the export bill, they can never come back. Okay, not at all possible to you. Even if the foreign buyer goes bankrupt, the bank loses the money, not you. That is the important area of difference between factoring and forfeiting. In India, factoring without recourse is not permitted at all. Forfeiting in general only, it is without recourse. Lastly, we have the TReDS, the discounting system for your trade receivables. Once the bank bids and pays the MSME, the MSME is off the hook and the bank collects from the corporate buyer. Okay, so more or less you can say that in TReDS it is not that difficult to recover because the companies from where we are dealing with, they are more or less reliable only. MSMEs, they have sold certain products to them and these companies more or less they are reliable, so the bank will be collecting with the from the corporate buyer. So the recourse factor in case of TReDS, as was written here also, for your recourse it is without recourse only, but not that difficult as compared to forfeiting. In forfeiting we have seen a number of examples of failure or bankruptcy. So when we talk about the difference between the workflow, all these three we will be learning via the examples again, that how the workflow functions. So in factoring, there is a local textile unit which sells to Fab India and gets the fund from Canara Bank factors, right? Like we have just now seen the Pune firm, Tata Motors, Tata Industries, and the example of SBI factors, that was factoring. Forfeiting, engineering firm in India, they export heavy machinery to Brazil and sells the 3-year payment plan to the Exim Bank of India, right? So for that you will be entering into a arrangement with the Exim Bank of India, and that too without recourse. You will be having the money from the forfeiting bank, and ultimately the forfeiting bank will be recovering from Brazil. TReDS, a small spare part maker, uploads an invoice from the Tata Motors onto the RXIL platform, the exchange platform for the MSMEs, and 3 different banks bid to provide the funds at the lowest rate. So bidding will be there. Always remember, in TReDS, it's not that you will be choosing directly. No, there will be bidding, and the lowest bid will always win. More or less the arrangement is same only the conditions, the platform will change, the process will remain mostly the same. Now comes the forfeiting. How forfeiting happens? Let's have an elaborate discussion, okay, with examples. When you are learning all these terms, all these terminologies, you will be able to make much more sense. So forfeiting is simply factoring for international trade, nothing else, right? Factoring for international trade, although you cannot just decipher from the abbreviation that whether it is some abbreviated term or we have some full form, but yes, it is simply the factoring for your international trade. Ultimately everything whatever is happening in these 3 processes, they are for trade finance only, fine, local trade, foreign or international trade, or for that matter specific trade like MSME, but with a no take backs policy. So no take backs means it is without recourse. The process, it involves medium to long term receivables, like we have big machinery exports, okay, so transaction will be for more than a year, not short term transaction. The forfeiter will do what? They will buy these export bills and takes on all the risk. They will say the risk is mine, I will be recovering on your behalf, just give me some service charge. If the foreign buyer defaults, the forfeiter loses the money, not you, okay. So for India, what kind of example we are looking at? So Tata Motors, it exports a fleet of buses to the transport company in Sri Lanka. Now when the transporter company, which is situated in Sri Lanka, they have requested or they have registered for the particular fleet of buses from Tata Motors, they must have certain business model in their mind that with these buses we will be doing something, expanding our local transportation, domestic transportation. The Sri Lankan company wants to pay over the 3 years to the Tata Motors, but whether Tata Motors agrees to this or not, if yes, then okay, because Tata Motors is a big company, unlike the Pune firm which we have seen, a small company. So if the Tata Motor does not want to wait or risk Sri Lanka's economic stability, they sell the deal to an Exim Bank, right, which will be acting as a forfeiter for Tata Motors. Exim Bank pays Tata upfront, and Tata is now out of the transaction, fine. Nobody will be questioning Tata now. They have their money, they have paid the fee to the forfeiter, they are now free from all the obligation, at least for this transaction. It is without recourse, meaning the seller is 100% protected if the buyer does not pay. So seller is not having any kind of obligation even if the buyer fails once the forfeiter enters into the entire process. Now comes the TReDS, the trade receivables discounting system. How the trade receivable discounting system works, more or less it is just an auction system, right? You are trying to provide the final heads up to a particular service provider which bids for the lowest amount. So TReDS is a digital auction house created by RBI specifically for our MSMEs. It's an online platform where MSMEs upload their invoices, whatever invoices they are having. Multiple banks then bid on that particular invoice. They want to buy that. The MSMEs gets to pick up the bank offering the lowest interest rate that we will be fulfilling your requirement, but at, let's suppose, 1% interest rate, at suppose 0.5% interest rate, or for that matter 0.25% interest rate. So who will win the bid? The lowest bidder. A small plastic component maker, let's suppose, falls in the definition of MSME only. So they are doing what? They supply the parts to Maruti Suzuki, The MSME uploads the invoice to the platform, like we have RXIL, M1 Exchange, and these particular invoices will be seen by various banks who are a member of these platforms. So ultimately, when we talk about one enterprise, they will be doing what? They have the capacity to supply something. So they are what? These enterprises are the suppliers. Okay. And once they supplied to, let's suppose, Maruti Suzuki, they will be having the invoice from the Maruti Suzuki only. Now 5 different banks see Maruti's high credit rating and bid to fund the invoice. Okay, ultimately you are giving what? Services in the form of providing the loan amount. More or less it is what? Just like a loan amount, but with minimal interest. So the MSMEs gets the money and at a very cheap rate, because the risk is based on the Maruti's reputation, not the small suppliers. Okay, so risk is what? The ultimate bank will be recovering the amount from a big firm only. So from where they are recovering, that particular company, that particular corporation, its credit rating will be at risk. They will be studying that company's credit rating, not yours, who is already a small MSME. Key detail will be it's transparent, competitive, specifically for MSME sellers dealing with large corporates or government departments. You will find that many CPSCs, Central Public Sector Enterprises, they are also the buyers of your MSME products. And for those reputed CPSCs also, the banks will be bidding, because they know that the funds which they will be requiring to recover from these CPSCs, they will come because of the high reputation. Okay, so this was it for today's session. If you have learned something new, do let me know in the comment section. Fine. And in case you have any kind of doubt regarding whatever we have studied, feel free to ask me in the comment section. And when we talk about the questions, we'll be attempting the questions also. But before that, let me just remind you that right now the registration window will close soon. Registration for JAIIB examination will close soon. Okay, today is 21st, 22nd is the last day. So after you are done with the registration, your next plan should be to crack the examination via dedicated preparation. And here at ADDA 247 we have JAIIB Mahapack 2.0 to suit all your needs for JAIIB exam preparation. So here in the Mahapack you will find not only the daily live classes, but also you will be able to see the recorded videos, the recorded classes. Along with that, after you are done with the live classes, recorded videos, you can attempt the mock tests also. You should attempt the mock tests also, because ultimately practice matters. And then lastly, while you are done with the entire syllabus, whenever you have completed the entire syllabus, you can move towards the full length mock test known as test series. Along with that, the note making, if you need to do, if you want to do, you can, but there is no need as such to make the notes, because we will be providing you the PDFs also from where we are teaching in our classes. So all these will be available for all the batches, whatever batches we are coming up for the JAIIB May 2026 examination. And from yesterday only we have started our new batch, that is Success Batch. The classes of Success Batch are also included here. Officers Batch, Increment Batch, all the batches, the classes will be here. Plus, now since the examination is approaching, so we'll be coming up with the crash course also, so that all of you who have completed your examination preparation, they can have the first iteration of revision done. Then we also have the second iteration of revision done via the Power Pack revision batch. So these two batches will also be a part of your JAIIB Mahapack. And in Mahapack you will find the classes exclusively for English medium as well. Okay, so a win-win situation for you if you want everything in one package only. So JAIIB Mahapack will help you out. Now comes the question that from where we can enroll in the Mahapack. So you can directly call us on the number 0981 981 9247. This is the dedicated helpline number for all our bankers. And for maximum discounts on Mahapack, because right now we are giving you 4x validity also, 4x validity is ongoing on the Mahapack, you can apply the discount code Y1003. This is the discount code which you can use for making the purchase and having the maximum discounts. Okay, Y1003. Here, Y1003. This is the discount code. Okay. Now, let's try to answer the questions. Fine. Let's try to solve the questions one by one. So, the first question states an Indian MSME textile exporter is there. So, when you talk about the MSME, your mind must signal that we are talking about what? We are talking about a particular scenario where the TReDS is being asked. So, Indian MSME textile exporter has a long-term contract with the buyer in Germany. But now, when you will be, reading the entire question, you will come to know that we are not talking about TReDS anymore. We are talking about a company, an Indian MSME, from where some will think that TReDS question is there. Now, as soon as this exporter word is added, then you will think of it as a forfeiting arrangement. Fine, forfeiting arrangement. Nonetheless, let's try to read it out. The MSME textile exporter has a long-term contract with the buyer in Germany, holds a bill of exchange maturing in 2 years. Fine, the maturity is within the 2 years. The exporter wants to liquidate this instrument to manage the cash flow. And when you talk about without retaining any liability if the German buyer defaults. So definitely we are talking about forfeiting now. Which financing mechanism is the most appropriate one for this scenario? Now this is just a question which will test your foundation of the entire unit. So first of all, you should remember that which type of arrangement we are talking about. In the first 3 words, we were thinking it's about the TReDS, and in the end, we were very much clear we are talking about forfeiting. But whether it is about factoring or not, right, try to answer the question. And such questions, such types of small cases, if you keep on practicing on regular basis, then only you will be able to say for sure that yes, come whatsoever from unit number 37, I'll be able to answer that question. So what will be the right answer here? TReDS, because it involves digital invoices and competitive bidding. Where is it written that we are talking about the competitive bidding? Factoring, because it is the standard method of short-term domestic receivables, but here we are talking about 2 years, not short-term, not within 1 year. Forfeiting, because it is international, involving negotiable instruments and is without recourse. Yes, the particular textile exporter do not want any kind of liability, no liability. So without recourse. With recourse factoring, to ensure bank's risk is minimized. What is the right answer? Correct answer is option C. We are talking about forfeiting. Fine. And this question was asked once in the examination for 1 mark. Okay, this is a 1 marker question. A very simple one. Still, students were unable to answer this question because they were not having the right approach to study this particular chapter. The right approach would be always try to have your basics clear, and after your basics are clear, then move on to the examples. With the examples only, you will be able to answer in a much better manner. Next, which of the following statements regarding the cost and the risk structure of trade financing is correct? Ultimately, we are doing what? Trade finance is happening. Fine. So, what all is given? Let's see one by one. You have to tell me the statements are regarding cost as well as the risk structure of the trade financing, and which of the following is correct. Okay. So, in TReDS, the interest rate is fixed by a single factor, similar to the domestic factoring. What is the difference between TReDS and factoring? We are talking about bidding. A bidding process is there in TReDS, but in factoring, no kind of bidding is there. You are free to choose whatsoever you want. Forfeiting, costs are usually linked to the benchmark rates of LIBOR, London Exchange and SOFR. Yes, that we have seen in the difference table, the first table we have seen today. Factoring is always without recourse, meaning the seller never has to pay back if the buyer fails. In India, without recourse, factoring is not at all permitted. TReDS is an international platform that allows multi-currency bidding. It is the Indian platform, okay, developed by RBI, and the bidding process is there. So right answer will be what? Option B will be the right answer. Okay, that is why I am saying that if you have a clarity of thoughts, if you know for sure that this particular topic of TReDS or forfeiting or factoring has certain keywords, and I remember those keywords with examples in the exam, you won't find the case studies difficult at all. Ultimately, what is this? This is a case study only, a smaller one, yet we will call it as a case study or a case based question. And in the examination you will find some lengthy case study but talking about the same concepts only. Fine. If you have given the examination of IFS earlier, you must be knowing that although the cases are very big, but ultimate options are single line only. Fine. So do not get worried when somebody says you that yes, case studies are asked in IFS examination and you won't be able to crack the IFS exam if you do not know about the lengthy case studies. No, it's not true. Just focus on your concepts and your keywords. In IFS, all the confusing concepts you can understand via certain keywords. That is why we have started this lecture with what? With the table which enlisted the points of difference. Fine. Okay, so yes, this was it for today's class. If you have any doubt regarding whatever we have studied today, feel free to ask me in the comment section. And also, if you are interested to enroll in a course where everything is provided to you, you can directly call us on 0981 981 9247 for more details. So see you guys in the next video. Till then, goodbye everybody, take care and try to revise whatever we have studied today.